There are lots of things you could do. Bury it in a tin can in the backyard, for instance. But idle money may in time depreciate. Or you could spend it on a couple of nights out a week with the wife. This seems like a lot of fun. But with this kind of life, you'd depreciate. So why not put your money to work?
Put my money to work?
That's right, Mr. Finchley. You can own a share of American business. There are over 1,200 companies listed on the New York Stock Exchange. Companies which employ more than 11 million people, produce half of all the goods made in America, and pay about
Welcome back. This is Ask the Compound, your number one-stop shop for all your finance-related questions. On today's show, we got a good, diversified set of questions. The best tax-deferred retirement savings vehicles. Is it time to get up from target date funds? Someone actually asked me this. Me of all people.
The audacity.
What's the story with gold? Why is gold up? Why are rates up? Why are stocks up? Some advice for a guy retiring in his mid-30s. This is obviously a fire person. And then some tax-aware strategies for selling your Mag 7 winners. Remember our email here, askthecompoundshow@gmail.com. Today's show is sponsored by Public. Time could be running out. To lock in historic yield at public.com, you can lock in 6% or higher in a bond account. Anyone who lived through the 2010s know these yields that we have today are promised to no one. Duncan. Rate cut. Now, we also, listen, rates have been rising lately, but we have potential of a recession, disinflation. I looked today. Inflation has been under 3% for the last 12 months straight. 14 of the past 16 months. It's been under 3%.
You wouldn't know that from Twitter.
This is true. So, listen, if you want to lock in 6% or higher yield with a diversified portfolio of investment grade and high yield bonds, you have to act fast. The good news is it only takes a couple minutes to sign up at Public. That's public.com/ATC. Disclaimer, this is brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24 for those yields, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Nice. That was a tongue twister.
Do what I can. All right. We got some good questions. Let's get into it.
Okay. Up first today, we have many finance people advocate for Roth assets with statements like all Roth all the time. Looking at you, Jill, on money. However, isn't there also a strong case for traditional IRAs due to the standard deduction? It seems like there's a solid argument for both Roth and traditional contributions. I never hear anyone bring up the standard deduction argument. Seems like a way to get traditional dollars completely tax-free in retirement.
Listen, if you ask for someone by name for this show, we will bring them out like a genie in a bottle. Bring her in here. Jill on Money is here.
Hey, Jill.
Are you an all Roth all the time kind of person, Jill?
A lot I am, because I love the certainty of knowing what my tax liability is. And, you know, I'm an Ed Slott aficionada, and I really
Bill Sweet, that's like Bill Sweet's hero. He loves that guy.
I mean, he's great. And, you know, yes, there are certain cases where it can work out, but I love the certainty of knowing what my tax liability is. And that's really the issue. And by the way, tax rates are so low right now. The certainty of paying the tax today versus what I think could be rising tax rates in the future makes me say, okay, I'm going to amend it for our listener, for our viewer. And that is all Roth most of the time, with a few little cases outside. What do you think, Ben?
I do. I mean, I'm a convert to the Roth. You know, Bill Sweet has talked me to this too. We finally opened up a Roth 401k at Ritholtz a couple years ago. I, of course, made the change to that. I still don't understand I put Roth dollars in, but my match from the company is in traditional.
Yeah,
that's kind of
weird.
Bizarre.
Well, I would talk to management about that.
I know those guys. I do like the idea of some tax diversification, because I think for young people, I feel like some people, the spreadsheet warriors will ask us, well, what if I just go into traditional and then I take my tax return and I save the difference and invest it? And most people aren't going to do that, right? You're going to spend your tax return on something else. So you're not really going to do that. So I probably filled up the traditional bucket when I was younger, and I've worked on filling up the Roth bucket more recently. So I like the fact that I have a little diversification. But if gun to my head, which, usually you don't have a gun to your head for financial decisions.
No.
I'm picturing like Jason Bateman and his Netflix show tied up, and that doesn't happen with financial decisions.
No.
Roth
You know what?
traditional.
But I also can say this, that, I'm at the other end. I'm probably the oldest person here by, 2 decades, at least, maybe 3. I think that a lot of the listeners to Jill on Money and also a lot of my cohort, the problem we have is that we've already saved so much money pre-tax that the problem continues to compound. And the issue is, if you've got, if you're 38 years old and you got $1 million in traditional, that problem is only getting worse. And those required minimum distributions, they're nasty, because that pushes you into different tax brackets than you thought. It changes your Medicare payments. It's just like a lot of stuff that is out of your control later in life. And I'm a control freak when it comes to my money. So that's why I think I lean Roth in so many cases.
Right. Most people are probably like you, where they have more traditional IRA assets than they do Roth. And balancing it out with more Roth assets makes more sense. That makes sense to me.
I've heard some people talk about splitting it up for your 401k, doing some traditional, some Roth. I mean, is there much reason to do that?
I mean, it depends. I mean, if you are, I guess that if you're really uncertain and you want to like play both sides, I just don't see a huge downside of being mostly Roth, especially if you've got time, because I think that the idea that money is going to grow without any taxation ever is pretty appealing to me.
Makes sense.
I like it. Okay. All Roth most of the time. Most of the time.
Most of the time.
That one was from Zachary. So
Next question.
up next, we have a question that came in on Twitter, I think. Why would anyone recommend a target date fund? My 2055 underperformed the S&P 500 over the past 1, 5, and 10 years and has higher expenses. What am I missing? I feel like this is very targeted to you, Ben.
It is a targeted question about a target date fund. Listen, this is like going to the buffet and asking, "Where's my fillet?" Right? When you go to a buffet, you're gonna get like some decent food. It's okay. You're not gonna get the best option. You're not gonna get what's Josh's favorite one every time I go to a steakhouse, like the tomahawk or whatever. It's like got a Fred Flintstone bone in it every time I come to New York. So here's throw up a chart, John. This is the S&P 500 versus a Vanguard 2055 fund, and you can see the S&P over the last 5 years is outperforming by quite a wide margin. It's outperforming like 40%. But this fund has not only a total stock market index fund for the U.S., it also has international stocks, it has international bonds, and it has U.S. bonds. It's pretty equity heavy still. I think it's like a 90-10 fund, but it's underperformed because it's more diversified. So you could always invest in the rearview mirror and say, well, why would I invest in anything else besides the thing that did the best? But I think that's a little harder to do going forward than it is in the past.
I also think that there has to be a recognition that for some people, that probably not watching this program, but for some people just like starting out with something, we want people to just start. It's like, okay, if that is the gateway drug to investing, then I'm okay with it. I think the bigger problem that you find is that a lot of people will have a target date fund and then have like 4 other funds in their retirement accounts. Like, either just start with your target date fund or just say, all right, put in an index fund and an index bond fund and go to sleep at night. It's fine. But I think that if we're just saying what is the easiest step to start, that's not the worst one.
Right. Yeah. If you want to have all your money in the U.S. stock market or the S&P 500, I'm sure you'll go have at it. But I do agree that this target date fund is a wonderful step forward for people who just look at their 401k lineup and go, I don't know what to do. And a lot of that money in the past would end up in a stable value fund. And it would never get the stock market or never get diversified exposure. So the great thing about target date funds is it's professionally managed. It rebalances automatically for you. They handle all the diversification in one spot. Like, it's a great starting point. I agree. People will poke holes in it and say, well, there's this problem and that problem. But guess what? It's better than most of the alternatives.
Right.
So it could be better, yes. It also could be way, way worse.
I also want to just remind everybody, and I know Ben knows this, there are some plans where the target date fund is so dumb expensive that it's like a head scratcher. It's like, you guys have to be thieves on that? Like, that's
Right.
We're just trying to
Right.
get people to start. Like, that's not where you should have the thievery. Save that for your emerging market fund.
And good thing, most 401k plans, if you want to do it on your own, and you still want to be diversified, there's usually a button you can click that says rebalance this for me annually, automatically. And then you do it and you take yourself out of the equation. You don't need to do it. So if you want to be more diversified, you can create your own set of funds, Or if you just want to have it in one U.S. stock market fund and you're okay with that, sure. But just know what you're getting yourself into. We're comparing apples and oranges here. It's not the same thing.
I kind of like building my own, personally. But
You don't want to use a target date fund, Duncan?
nah.
Duncan, you don't want to have 100% in a single stock?
No. I'm diversified ish.
All right. Ish.
All right. Next question. Speaking of diversification, we got a good one here.
Yeah. Up next, we have a question about gold, which is a common one these days. What's the story with gold these days? My understanding is that in times of peril, gold is where people go. In the most perilous times of the last 5 years, I feel like the price of gold really didn't do anything. It wasn't the hedge that most people believe it to be. Can you thread the story of the stock market, interest rates, and gold? Is gold no longer a good hedge against market turbulence? Is Duncan trading levered gold futures? Make it make sense. Is there a levered gold ETF?
I'm sure if it existed, it would be in your portfolio.
It's possible.
Good use of the word peril here. I don't use that word enough. My instant reaction here is markets don't always make sense. So, Jill, I have a series of stock charts I want to run through, and then I want to get your take on these.
Let me put my glasses on for this. Get going.
So the first one, John, throw it up here. This just shows the one-year return for stocks in the S&P 500 and gold. They're both up roughly 40%. The stock market is up 43% over the last 12 months. I updated this morning. Gold is up 38%, call it. And, John, next chart, please. So that's over the last year. This is the history of gold versus the S&P 500 rolling 12 months returns, going back to 1970, which is effectively when we got off, the Nixon got off the gold standard. You can see that these things they don't always move in lockstep with one another. Usually they're way out of whack with one another. And I actually had to cut this chart off because returns were so high in the 70s and 80s. The best 12-month return for gold since 1970 was like 180% in early 1980s, late 1970s. The best 12-month return for stocks, I think, is 60%. So you can see this doesn't happen very often where they're both moving up. In fact, I found one other instance in November of 1980 where both stocks and gold were up 35, 40%-ish at the same time. Happened one time in this past 55 years or whatever. So it's very rare to see what we're happening this year happen. So all right, one more, John. This is gold and stocks annual returns by decade. 70s, gold crushed the stock market. 1990s, 1980s, stock market crushed gold. You had two lost decades for gold in a row. Then you had a lost decade for the stocks in the 2000s, and gold did well. 2010s, gold performed poorly again. Stocks do well. This decade, so far, halfway through the decade-ish, we're looking at stocks and gold both up quite a bit. So both double-digit annual returns. That has never happened in the past 6 decades. So this is kind of uncharted territory here. And my whole thinking is that stuff that has never happened in the markets tends to happen all the time, and kind of get used to it. But I think my big takeaway here, my Zen philosophy about investing, is that sometimes the reason doesn't matter, right? Because you could say, well, gold's an inflation hedge. Sometimes it is, sometimes it isn't. Gold does well when real interest rates are low because gold doesn't pay any cash flows. But this year, real interest rates are going up and gold's going up. And so I think if you try to pigeonhole yourself into some sort of if-then framework about the market has to work like this, if this happened, that happens, the markets don't work like that.
And as the former gold trader that I was, because I did get my start on the Commodities Exchange of New York, and I did.
So you're trading gold futures?
I traded gold options, so options on the futures. I was in the gold ring, and
so on Trading Places, you were down there. I think I asked you this before, but you're just open outcry shouting.
Yes, that's me. That was me, and they were like, "Oh, she's 5'11". She knows how to handle herself. She's perfect. Not big enough to be in the crude oil pit, but big enough to be in the gold pit." And I wasn't trading futures. I was trading the options on futures. And you know what's fascinating to me is that forever, remember, I started trading in 1987, so I wasn't even in the heyday of gold. But when I got to the COMEX, there was like that haze of like, oh, remember when? And you could see that already it was, hate for the pun, losing its luster in many respects. It was seen as essentially not just a hedge against inflation. It was the Armageddon trade. It was if everything goes to hell in a handbasket, you want to own gold. And my first lesson with that was in October of 1987 when the stock market crashed and, everybody was really nervous and they said, oh, everyone go home long gold. And I screwed up my calculation and I went home flat. and my boss chewed me out in front of everybody and saying, I told you to go home long. I told you to go home long. And the next morning, gold opened limit down $25 because there was so many margin calls in the stock market that
people were
everyone
selling
sold.
whatever else was doing okay.
Exactly.
I never even thought about it. I never looked at what gold did in the 87 crash. So it actually fell down the next day.
Yeah, it fell down the next day, limit down. And so here's what I can tell everybody about gold. I agree with you, Ben. Nobody really knows. I heard Josh articulate a view recently that I thought kind of made sense, which is, maybe it's not so much an Armageddon against market disaster, but about global insecurity. So that if you are a country and you're worried about sanctions or you're worried about trade wars, that gold is not something that anybody can look at from the Treasury Department and say, we're locking you out of your account. So there is something to be said for some sovereign nations buying gold. The other thing is there's just a lot of money on the sidelines being thrown at ideas. And if gold is an idea and crypto is an idea and everybody just wants a little idea that's somewhat different, fine. As somebody who was a gold trader, what I can tell you is actively trading gold is a recipe for disaster, unless you really know what you're doing. And if you want to have some small position in gold, like 2%, 3%, go at it. I don't own any. I'm the woman who was a gold trader. I don't own any gold.
But it's the kind of thing where I look at it, if you're holding it as a diversifier in your portfolio, you hold it come hell or high water. You
bet.
You don't try to get in and out. You hold it, you rebalance into the pain,
Yep.
You take some money off when it's doing well like this year. That's how it works and helps your portfolio over time because it's a volatile asset and you want to trade around and rebalance it. But that's the thing, is not trying to jump in and out.
Yeah, I agree 100%.
This is also on the same kind of topic. I was asking you a while back off show, Ben, like how these doomers that have been so negative for so long aren't just all out of money. And you were basically like gold kind of bailed them out.
Gold bailed out Zero Hedge.
Or baloney that they really are 100%
Yes.
against.
Right.
I think that I don't believe it unless I saw your trading rundown and I saw your account statement, then I'll believe it. Otherwise, I think there's a lot of jawboning. I've known a lot of quote-unquote perma bears who are quietly long S&P futures just in case.
Right,
yes,
right.
I wouldn't doubt that if there's some perma-bear newsletter writers who have S&P 500 index funds.
Yeah.
Well, I know a famous short seller got, I think, in big trouble recently or went to jail or something over that very thing, doing the opposite of what he was telling his people.
You go to jail because you don't short stocks in the US of A, right?
Hey, I mean, fair's fair.
Next question.
Okay, up next we have one from David. I'm planning to retire next year, age 36, on a 5 to 6% withdrawal rate from my non-retirement accounts. Given that I can't touch my retirement accounts for another 23 and a half years without paying penalties, would you recommend doing annual Roth conversions up to the standard deduction to avoid paying taxes, to avoid overdrawing from my non-retirement accounts?
Big time fire guy here, 36 years old.
Wow,
So
what are you going to do? What's he going to do at 36?
that is the big question. What are you going to do with your time? Probably become a fire blogger, I would imagine. First blush, 5 to 6% seems high, but it sounds to me like he's going to use the 5 to 6% for the next 20 whatever years while he can't touch his retirement accounts and then transition into using the retirement accounts from that point. So I guess the 5 to 6% at an initial blush seems high, but it's probably not as high as it seems because it's going to, that money will probably run out eventually, I guess, would be the option. So let's say that his plan works out and he retires at 36, then he can finally start using his retirement assets in like 25 years. Does this make sense to the annual Roth conversions? Are you on board with that?
Well, I'm unclear because I need to know the actual dollar amounts. So I think the problem is, like, I would hate to soak up all of your liquidity doing Roth conversions. That's the only thing that I'm worried about. So, if you have it, I don't know what the numbers are. So let's pretend he's got $2 million in his retirement account and $1 million in non-retirement account. And he's just going to let the retirement account go. Do you really want to use your non-retirement assets to do the conversion with the fear that you are overly ambitious? Like, it would be great to do it at 12%, fantastic, but I am concerned that you don't soak up all the liquidity in the non-retirement accounts too quickly. That's the issue for me. So you tell me how much money you have outside and how much money you have inside those tax-deferred accounts, and then I think we have a better chance at giving you an answer that makes more sense for you.
I get that because maybe you're setting yourself up for the future, but you're hurting yourself in the present to do so.
Right,
And you
exactly.
have to maybe balance that a little. I do think your point about what are you going to do with your time here is something that probably not enough folks pay attention to. And that people in their 30s or 40s or 50s or 60s, right? Like, what are you actually going to do with your time?
Ben, I cannot tell you how many times people come onto my pod and they'll say, I'm 52 and I want to retire. And my response is normally, what? What are you going to do? And that's probably because I am turning 59 and I can't imagine really being done. And I think the number of people who are not giving thought to this, even if you're in your 40s, your 50s, your 60s, having some semblance of an off ramp to get you from like balls to the wall working and really like pushing it to doing nothing. I think there's a real danger in that. And the people that I know, I'd hate to be the kind of person, I know so many folks like this. It's like they work really hard, they get to the number, they're done, and then they actually are like completely bored and don't know what to do with themselves. And they're driving their spouses crazy. And then they end up going back into the disgusting rat race, doing something really that they worked so decades to get out of. So when you're thinking about retirement, think about, is there some period of time? Is there a 5-year period where I can do something a little different, where I could maybe give my notice, but then act as a consultant, or where I can say, I need to make sure that I have something to do with myself. You are likely, if you're going to retire at 36, 46, and even 56, let's say you retire at 56, you could live for 35 more years. Are you going to do nothing? Nothing for 35 years? I doubt it. You're going to have to figure out how to occupy yourself.
The sense that I get from a lot of the FIRE people, financially independent, retire early, is a lot of them hate their jobs. And that's the reason they're doing this. It's like, I'm going to take big time pain now, tons of delayed gratification, and then I'm done and I can leave this job. So the point, if that's your case, then I get that. I would not want to be part of a soul-sucking job. I've had jobs I didn't like in the past. I understand how that works. But I think then you need to figure out, okay, what do I really want to do then? Like now, if you've given yourself the financial freedom, now go do what you want to do that can actually make you happy.
One of our listeners, we discussed this, and the person, we just kind of came up with a new acronym. Instead of FIRE, I think that most Jill on Money people are more like the FINE acolytes, meaning that financial independence next endeavor, that people want the opportunity to do something different and to save. Maybe you don't have to have the same level of pain and deprivation. Maybe you can just say, well, I'm going to save a little bit more now because maybe when I'm 45, I'm going to want to do something different for 10 or 15 years. And that next or that new endeavor is such an exciting thing for people. And I think can really be a valuable part of your own personal growth. Like if you've done the hard work, you've got the money, but now you really can take a change and do something and make yourself feel better, be part of a mission-driven organization, which has its own problems perhaps, but just doing something different that you're psyched about. A lot of people, Ben, that come on my program, they'll say to me like, I really want to become a financial planner. I'd love to do that. How do I do that? And we talk about
relaxing.
the steps. Yeah, it's kind of awesome. Like, hey, no, it's not so much relaxing, but like, it feels like you could do good. Like you could do good in the world helping people. Like Ben.
Did you trademark the FINE thing yet? I like that one.
You know what? I think I put it in my book in The Great Money Reset, but it really is, I think that it is more of a known quantity. So please use it.
But especially with people living so much longer these days, even the baby boomers are retiring in their 60s, like you said, 30 years maybe, like you have a whole second act potentially that you could be doing something with.
Yeah, and I do think that the engagement, I think that people really discount social engagement. I have a friend who actually stopped teaching after teaching for 40 years, 40. And she goes and she substitutes and she works as a substitute in her system like a couple times a month. And she said, it's like my Pilates money. I get to hang out with my friends. I get to be with the kids who I love. And like on a little like twice a month basis, fantastic. So
my dad retired at 62, I think, probably a couple years earlier than he thought. He did okay, and he's like, all right, I'm going to do it. And he went to work at a winery so we could get a 50% discount on the wine.
Love that. We had a guy, by the way, on the show who ended up, he loves tennis, and he works for the USTA and travels around the country for USTA tournaments, like driving professional tennis players from the venue to their hotel. And he gets to go to all the tournaments for free. I'm like, that's an awesome job.
I like it.
Yeah.
I have an idea. There's gap year for young people going off to college. What if there was like the retirement version of that? You hit 50 and you take a couple of years and you just go travel. Because, Josh and other people we've had advisors say before, it's not fun to travel when you're 80. You know what I mean? So like, go ahead and get all your traveling things you want to do, when you're still relatively young and Yeah.
I
Why
like
not do that?
I like that.
All right, we got one more question.
Okay. Ben doesn't like it.
No, that's what cruise ships are for, Duncan. They go on cruises.
Yeah, but there's a Viking river cruise that goes on for like 180 days or something.
Yeah, you go around
Dude,
the world.
you are watching way too much Masterpiece. I know that right now. If you're telling me where the Viking
true.
cruises are,
I'm a big Rick Steves fan.
Yeah, I know it.
Steves fan. Yeah. Okay. Last but not least, we have, as a long-term investor, I've accumulated substantial capital gains in Mag 7 stocks, which now dominate my portfolio. I'm increasingly uncomfortable with the concentration risk. My dilemma is, how can I balance tax efficiency with the need to diversify my portfolio and reduce risk? I'm hesitant to let tax considerations dictate my investment decisions, but I also don't want to incur unnecessary tax liabilities.
This is the kind of question where people want to look at it from a outcome-oriented view, right? Like, I don't want to sell and the price keeps going up, but I do want to sell if the price goes down.
yes.
And obviously, we don't know what the price is going to do. So you have to make sure that you're making this decision with only what you have now, and don't look back on it in the future and try to regret one way or the other. Like, I should have done this or I should have not. You don't second guess this kind of decision. You do it. But this is the kind of question we get all the time from people, especially in these kind of, which, boo-hoo, you have too much NVIDIA gains, right? Like, you won the game. Taxes are part of playing. But where do you fall on the tax tail versus the dog?
Dude, I
portfolio?
love paying taxes. I love it. I think that like tax minimization is great, but like you killed it on a trade, take some money off the table. Oh, here's another idea, by the way. I suggested this to Josh when NVIDIA like made a charge up in a short period of time. I said, why don't you create a charitable account? You know, you can do it at Fidelity, you can do it at Vanguard, and you know what you can do? You can gift your shares into your charitable trust. This is a donor-advised fund. You can gift the shares in there. You can get a tax deduction this year. You don't have to give all the money away for years to come. Like, it can be like a few years in the future. But you can get some of that money off the table, get a tax deduction for that, by the way, and you'll have all your charitable giving set up for like a bunch of years. And this is especially good if you want to like bunch your deductions. You want to get this all in 1 year where you're making money. But generally, if you're not charitable, okay, I get that. And a lot of people don't have that as part of their plan. Sell a little bit, pay the tax, move on. 23.8% is your top bracket. It ain't the worst thing in the world.
Right. Yes, it could be worse. You could be trying to harvest those losses.
Exactly.
But I don't think, I think the bigger regret for most people would be, I held on too long and a lot of my gains disappeared.
Yeah, I mean, look, I know that and I get that feeling, but you don't look back. You say,
No.
sometimes the best decisions are made by accident. I remember I had a client 100 years ago when I was still in the business, and they were selling their Texas Instrument stocks. It was 1998, okay, the end of 98, and they wanted to buy a house in Florida. So we sold a bunch of the Texas Instrument stock, took the gain, and then, for 1999, it looked like the worst decision in the world because the stock kept marching higher. And then the entire thing collapsed, 6 months after that. So in 18 months, this guy felt the agony of defeat, but then had his eyes wide open and said, oh my God, I was the luckiest person in the world to sell at that level.
So I have a story. I'm not trying to one-up you here, but we have a story of someone who came with us and their whole portfolio was in XIV, which was like the volatility enhanced whatever. It was trading on the VIX. And this thing was going crazy, and it was basically betting on low volatility to remain forever, right? And they came to us and we said, no, this, you cannot have this as your whole portfolio, any of your portfolio. Like, this is a day trading vehicle, and so we had them sell it because it was prudent. And then the ETF proceeded to double over the next 3 months. Oof. And they called us and said, what is wrong with you? A week later, it literally went to zero. The whole, remember that XIV, Duncan?
Oh, yeah.
The whole, volatility, and it wasn't even like a crazy correction. It was like a 10% correction. And however they structured this ETF, it blew up and went to zero. And they kind of went, okay, got it. You're good now.
But think of the tax loss harvesting opportunity.
Oh, yeah, right. From gazillion to zero. You know what? And the other thing is, sometimes you make a decision and it can just be a prudent decision that doesn't work out perfectly well. But, sometimes you make that decision because you are deciding which is the risk you're willing to absorb, right? Do I want to see it drop in half, or am I going to be sad if I miss the next 50% higher? And that's a good question to ask yourself. And you don't have to sell everything, but you can take pieces of it and sell it. All these CEOs who register and say, we always talk about this. Oh, so-and-so, this one's selling so much. Oh, well, this is terrible. David Solomon's selling Goldman Sachs stock. He must not feel good about it. You know what he's doing? He's being prudent. He says, I have an enormous amount of my wealth in this one company. I am selling some of it, and they do it every single year. Every C-suite executive does that.
You can sell the whole thing. You don't have to sell the whole thing. You can still let some of it ride. It's funny. Michael and I were talking this week. Every time it looks like Bitcoin is setting up for a new bull market over the past, 5 years, Michael and I will have the conversation. Okay, what level would Bitcoin have to get to for you to take a big chunk off the table? And we put our targets on, and usually the goalposts move as Bitcoin keeps going up, and we just don't end up selling. But this time we were talking. We're like, all right. If Bitcoin hits 100,000, if we get in we have to take some off the table here. We're going to sell. And then it's like, yeah, but what if it goes from 100 to 150? And it's like, you have to be okay with that.
Right.
That's the thing. You have to be okay with that. And you have to know what you're going to do with the money in terms of rebalancing or using it for something potentially. But you have to be okay with the fact that that happens.
Yeah, and whatever your decision is, don't look back. It's not worth it. It's not worth your time and the energy.
No.
Just move on. There's always something new and exciting that's happening, and it's probably a better use of your time than looking back with what your regrets are.
That really resonates with me right now because I sold my Tesla at 230, and it's in the 260s or something now. So
You made money, right?
I did.
So
That's true.
Yeah.
all right,
There you
and
go.
you are independently wealthy, so that's fine.
Yeah. Exactly.
I know that this is actually your off-ramp job. This is your next endeavor job.
I retired at 27.
You
Duncan
retired
was
at
the
20.
fire guy.
Wait, the 27-year-old with an artistic career who hit it big.
Yeah, exactly.
I got it.
It's the
All
way
right,
to wealth.
Jill, you're all over the place. Where are we going to find you in the next week? CBS, The Compound, your podcast? Tell people where they can find you.
Jill on Money is the podcast, CBS Mornings or CBSNews.com or The Compound or hanging out with Ben. Ben, I'm using one of your charts in a segment tomorrow, I hope. I'm
That's
hoping
great.
that.
And yours
crediting
truly is
Ben
going to be on
Carlson.
Jill on Money next week.
Yes.
All right, yep.
Exciting. He's the best.
All right. Our email here, askthecompoundshow at gmail.com. We appreciate all your emails. Thanks, everyone, for tuning in live. We appreciate it. We always love having Jill here. See you next time.
Thanks, everyone.
Thank you.